This is where we are. This is the standard disclaimer for you. This is just for the general discussion. This is not advice. And views are my all personal. Somebody did scratch on the screen. Never mind. Right. Ladies and gentlemen, this is my session plan, and somebody who were in my session in the past understand what this gentleman means here. There is a reason. I'm sure somebody would already know who this gentleman is, and someone who wouldn't know, you will see towards the end of this slide as to who this is and why he's here. And this slide is effectively the session plan, the index for today's session as to what we are going to be doing. So we'll be looking at some introduction, brief history, sources of the UK tax law, income tax, national insurance contribution, capital gains tax, inheritance tax, corporation tax, VAT, of course, the stamp duty, land tax, some business discussion around unincorporated and incorporated, if the time allows, individual versus company, and finally, here is the gentleman is about. Mr. Baba Ramdev from India. I call him as king of humor, and I would love to bring him to my session every time if I could. So here we are. This is the UK Revenue and Customs. See, many years back, there was two distinct departments of Inland Revenue and Custom and Excise. So Inland Revenue used to deal with direct tax like income tax, corporation tax, capital gains tax, and so on. And the Custom Excise used to deal with the indirect tax, for example, VAT, Custom Excise, and so on. In 2005, about 2 decades ago, these two government departments get merged and become something called Revenue and Custom. Her Majesty Revenue and Custom. Now, His Majesty Revenue and Custom. And not long ago, just 2 decades, they were two different departments, and they invested a lot to merge these two departments into one. And this is the logo of the Inland Revenue, and this turned into the Revenue and Customs back in 2005. Up to 2013, this was the logo, and from 2013, the third one is the logo of Revenue and Customs. Let's move on. Let me just try and find out. So I will be discussing through some of the UK and UK tax history to begin with. This is the United Kingdom. The yellow circle includes Scotland, England, and Wales. That's called Great Britain. And added to that, Northern Ireland is called United Kingdom. So basically, United Kingdom is a combination of 4 different countries, but it looks like one. You'll see, back in 1700, those 3 countries come together and become Great Britain, England, Wales, and Scotland. And 1798, ladies and gentlemen, you can see here, it's the first time UK or the Great Britain introduced income tax, implemented income tax. And primarily, the objective of introducing this income tax was to finance the Napoleon War. You can tell the introduction of income tax was not for the development, for the advancement of the people, but to fund the war back in 1798. It's obvious. It is more than 225 years ago. Therefore, UK has one of the longest tax history in the world. Probably the longest, if not one of the longest tax history in the world. And this is the first text of the statute of the Income Tax Act, 1799 at the time. So what happened at the time is that in 1798, about a year ago, income tax was first implemented, and then the Income Tax Act came into, and that's called Duties of Income Tax Act 1799. So this is the first official Income Tax Act of the UK, which has more than 226 years of the history. And 1800 time, the United Kingdom was formed together with the Great Britain and Northern Ireland. So the UK is a combination of Scotland, England, Wales, and Northern Ireland, as I mentioned earlier. In around 1799 to 1802, about 3 years, just under 3 years, that Income Tax Act worked. And then it was abolished for a brief period for about a year. And then in 1803, again, the Income Tax Act come reintroduced. Around the 1816, the Income Tax Act was repealed after the completion of the Napoleon War. But then, again, after some time, taxation began, Income Tax Act began. Around the 1870, for the first time, around 1870, Inland Revenue Act was introduced to govern the Inland Revenue Department of the government. For the first time, something similar to VAT, not exactly VAT, similar to VAT was introduced in 1940 called purchase tax, a kind of consumption tax. But what was the difference to VAT was that this tax was charged not for the ultimate customer, not for the ultimate user, consumer, but at the point of manufacturing and distribution, quite distinct from the VAT system we have in the world today. In 1965, UK started formally introducing Finance Act every year. And around the 1970, they have something called ICTA, Income and Corporation Tax Act 1970, which was revised in 1988 again. So it's called ICTA 1988. And the ICTA 1988 was there for quite some time. You'll see in a minute. In the 1973, UK joined the European Union. And at the time, European Union already has had VAT. Therefore, UK also replaced the purchase tax, which they introduced back in 1940 and formally introduced VAT in 1973, quite a while back. So I want to list these pre-war dates. You will see around 1803 up to 1815, about 12 years, the Napoleon War went on, the French guy. The First World War around 1914 to 1918, about 5 years. And the Second World War is around 1935 to 1945. Sorry, 39 to 45, about 6 years. The reason I'm listing these big wars around the world is because every time the war got induced, the income tax rate and the various other tax rate and the taxes got introduced and increased. As I mentioned earlier, after the end of Napoleon Wars in 1815, around the 1816 time, that Income Tax Act was repealed for good some time, because they said they didn't need probably the income tax, because they needed that income tax to fund this war going back 1799. So in the UK, for the first time, the income tax was introduced formally in 1799 to fund the Napoleon War, ladies and gentlemen. And this is the UK Code of Arms at the time. So let's carry on. I'm going to very quickly run through what are the different list of or the types of UK taxes introduced since then. I'm more interested in the income tax, but I just wanted to give you a very brief history. Going back 1692, ladies and gentlemen, UK introduced the land tax. And since then, there are a number of other taxes introduced over the period. I want to take you through a couple there. Let's see, somewhere around the middle of the page. Male servant tax, female servant tax, hair powder tax. Ladies, I'm sorry, look at that. Back in 1795, UK did have something called hair powder tax as well. And 1796, they even did have dog tax. 1797, they had clocks and watches tax. In 1784, they had game tax. In 1746, they have coaches and carriage tax, basically the bus taxes. So you can see there are different type of taxes before they introduce the income tax formally. So they did have different type of tax going back 1692 under different heading, but income tax was something introduced for the first time in 1799. What I'm interested in is this, the income tax. So the Income Tax Act is something introduced in 1799, and from 1842 onward, the income tax is always there. And other different name as well, as you can see, succession duty, corporation duty, state duty, different names and all that. I'm interested in capital gains tax, which was introduced in 1965. Let me tell you, ladies and gentlemen, even today, there are many countries around the world, they even haven't heard about capital gains tax. So capital gains tax is non-existent. For example, Singapore. For example, good few European countries themselves, they haven't got capital gains tax. But UK introduced back in 1965. Of course, the corporation tax liable for the company, value-added tax, capital transfer tax. Basically, it is the inheritance tax. And even the inheritance tax was introduced back in 1974. And today, I can boast that there are many countries, big number of countries, they haven't got the something called inheritance tax, including Nepal and many European countries themselves. And there is a type of inheritance tax, not exactly inheritance tax, a type of inheritance tax in the US, they call estate tax. We will touch base later as to what the inheritance tax is about. Very quick touch base. Now, let's look at how the HMRC department would look like. First of all, it is a non-ministerial government department. As said earlier, up to 2005, going back 1849, there was separate Inland Revenue Department. And from 1909 up to 2005, there was a separate Custom and Excise. In 2005, they merged together and become Her Majesty Revenue and Custom, HMRC. And this was announced by the Finance Minister, the Chancellor of Gordon Brown, in 2004. And later he became Prime Minister as well of the United Kingdom. So what the HMRC does, let's look at briefly. First, it collects taxes, direct and indirect taxes. Direct taxes simply means, for example, income tax, corporation tax, capital gains tax, and inheritance tax. The indirect tax means, say, VAT, stamp duty, well, not exactly stamp duty, but the excise duties and so on. On the other side, HMRC does some other things as well in the UK. First, it collects and deals with something called National Insurance Contribution, which we'll touch base shortly, and deals with the child benefits, the other form of state support, state benefits, for example, state pension, and the other support for the public. Anti-money laundering as well. Let's carry on. And HMRC also has a separate agency called Fraud Investigation Services. And this department deals with investigating and tackling tax fraud, excise fraud, smuggling, money laundering, and other various tax and other offenses against the government fund. And this is briefly the function of HMRC. Of course, HMRC does a lot more than this, but this is a brief picture as to what the HMRC is generally doing in major terms. Carry on. There are a number of important tax acts. I want to begin with this, the Taxes Management Act, which deal with generally the compliance, TMA 1970, Corporation Tax Act in 2 volumes, 2009 and 2010. It deals with the company taxes. There is also something called TIOPA 2010, Taxation of International and Other Provisions Act 2010. It deals with normally the cross-border international tax matters relating to the UK. It has Income Tax Act 2007, Income Tax Trading and Other Income Act, ITOIA 2005, Income Tax Earnings and Pension Act, ITPA 2003, Taxation of Chargeable Gains Act, TCGA 1992, Inheritance Tax, ISTA 1975, VATA 1994, Stamp Duty Act going back 1891, and there is a recent upgrade to this in actually just last year, the Stamp Duty Land Tax Temporary Relief Act 2023, and my old ICTA 1988. Ladies and gentlemen, until 2007, this ICTA was there. And ICTA covered both the income tax and corporation tax. Now imagine how big that ICTA may be. The ICTA has now divided into a different Taxes Act, and number of those acts were there together back up to 1988 under ICTA. And this ICTA was actually very famous up to 2007. It did cover a lot of corporation and income tax into one book. And they are not just these, there are many others as well. I wanted to list out the main ones for the purpose of TX and ATX, for the ACCA qualification and for the general discussion here. Plus, the sources of other UK Tax Act are these. Not exactly act, they are called the secondary or the delegated legislation. The one listed above are the primary legislation, and these are the secondary or the designated legislation. For example, a statutory instrument, extra statutory concession, ESC, HMRC do not issue these anymore, but they are there, a few which they issued in the past. HMRC manual. Let me tell you one thing about this HMRC manual. This is very useful book. Normally, these HMRC manuals have prepared, designed, not for us, not for the tax advisor, not for the client. They are for themselves, for their own staff, but they are publicly available. And therefore, they are very useful. And we do check HMRC manual very regularly. Ladies and gentlemen, can you see the PowerPoint? Somebody is saying they can't see the PowerPoint. Can you see?
Yes, I can see it.
Okay, thank you. Sorry, someone was saying here they can't see the presentation. I'm sorry, Suraj, it may be you. You might want to come out and come back in, just in case. Everybody else is okay.
Fine, sir. It's working now.
Okay, thank you. And the HMRC guidance. There are some HMRC help sheet calculation tools, etc. available. They are very helpful for the purpose of working out, advising, getting information, getting double checked and all that around the income tax and the other taxes matters to deal with the UK tax. And more importantly, various case law. And these are the main sources of UK tax law that's applicable. And there would be a number of case law every year coming from different court system within the UK coming up to the Supreme Court. So we will be looking into some of these in future whenever I'm coming up with other topics around these areas. But these are the primary and the secondary legislation, which are the sources of UK tax law. And one thing, let me tell you, when you put together all these legislation, they are almost impossible to carry. When I was doing my CTA going back many years, it used to be the open book exam. And we used to get all these books allowed in the exam. And I always used to ask my friend to carry these books with me because they are that heavy, really heavy. And the primary legislation themselves are around 7,000 pages. And the secondary legislation are way more than that. So I think if I put together all these primary and the secondary legislation, that would probably be around 20,000 pages. And I'm not joking. It's really, every volume of these are really a big size, very big size book with a small print. So there are quite a lot of the legal resources, legal source, and the materials around the UK Tax Act. Unlike quite a good number of participants are from Nepal, I can tell you, go back and look at the Income Tax Act 2058, how small it is compared to when we see this. And you can distinguish that. Let's carry on. I'm going to briefly touch base how the UK tax year looks like. I'm going to talk about for individuals. Individuals means the natural person. For individuals, the tax year, for example, 24-25 means 6th April 2024 to 5th April 2025. This is one of the weird thing about UK tax year, and this goes back many, many years. Generally, on everyday language, everyday discussion, everyday work and advice, we just say April to March. But in specific, for the individual, UK tax year runs from 6th of April 2024 to 5th of April 2025, when you take the example of 24-25. So basically now, where we are, it is the tax year 2024 and 25. So in a couple of months' time, this tax year will end for the purpose of individual personal tax return and everything else around the income tax, of course. So generally for the individual, when we do the tax return, we call that a self-assessment personal tax return 2025 or 24-25. So UK has introduced the self-assessment system going back 1996, about there and there about 36 years, or sorry, 30 years coming over now. So they have very matured self-assessment tax system and one of the very robust and very workable tax system in terms of self-assessment, both for the individual, corporation, and others as well. For example, the VAT, the inheritance tax, capital gains tax, everything is almost self-assessment. This taxpayer who actually calculates the income, the taxable income and the tax and write the check out to the revenue. That's the self-assessment system. And many countries around the world, they do have self-assessment tax return system now, including Nepal. Right. So this is governed by, or this is updated by Finance Act 2024, which is again, generally we call that 24-25. You'll see slight difference when we come to the company in terms of this period. That 6th of April to 5th of April will change slightly. It doesn't really matter. And this 5 days always gets ignored unless there is something very significant going around in these 5 days. When we are dealing with the usual businesses, self-employment businesses, partnership businesses, rental income, and the other things, and so on, we generally ignore these 5 days, unless this 5 days does have a lot of significant income gains, etc. But strictly speaking, 6th of April 2024, going to 5th of April 2025 is the tax year 24-25. Please mind it is important. Now, I'm going to talk through something around individual versus company. I would advise everybody, whether student, whether advisor, first thing first is this. First, distinguish whether you are dealing with an individual or dealing with a company. At the top, it is person. Person means not just the individual, also for non-individual. What I call is non-natural person. An example is, of course, a company. And on the other side, the natural person, for example, individual. An individual would have 4 different types of taxes to deal with: income tax, national insurance contribution, capital gains tax, and inheritance tax. And the company would deal with the corporation tax. Plus, individual and company both would have to deal with VAT and stamp duty where applicable. We'll try and come onto this if time allows. So you can see this little picture. First, always distinguish what you're going to be dealing with. Is it individual or is it company? The reason I mention this is because the UK tax system works not just differently, completely differently for individual and for company. In many countries around the world, I know they only call income tax. And that income tax includes the personal income tax as well as corporate income tax. But UK has distinct terminology, distinct system, and distinct rule altogether. Even the way things are calculated, the way profits are calculated, the way taxes are calculated are different. And in some cases, not just different, completely different. Let's look at the individual specific here. Individuals are liable to income tax. Sometimes we call it personal income tax, sometimes we call it personal tax, and sometimes we simply call that as income tax. On everyday language in the office, we just say personal tax. And the personal tax, I would like to divide here between the 2 major sources of income. One is non-saving income, and the other side, savings income. I have given a few examples there. Non-saving income means earned income. Earned income means self-employment, sole trader, freelancer, even partnership, employment, of course, being an employee, and for example, the rental income would also come under non-saving. The reason I distinguish this non-savings and saving is because the tax rate and again the way it works is different. So we need to first identify what we're dealing with, individual or company. And then if we are dealing with individual, then we need to find out whether the income that we're dealing with is non-saving or savings. Non-saving, 3 examples. And under the savings, I further divide between the two, interest and dividend. Of course, there are other sources of income as well, but they will fall under one of these categories. But under the savings income, the interest and dividends are also taxed differently. They have different tax rate, different tax-free allowances, and different calculation basis. I have a bit bigger table here. Please bear with me. So this table explains, first, UK has the personal allowances, tax-free personal allowances of 12,570. And it was the same last year as well. And for the next 37,000, we call that as basic rate. And after that, we call that as higher rate up to 125. And anything above 125,000, we call the taxpayer as additional rate taxpayer. And as you can see, for the different type of income, there's a different tax rate. So dividend has a completely different tax rate compared to non-saving and, non-saving and the saving income means the interest income. So interest and the non-savings incomes are taxed at the same rate, but the dividend is taxed at different rate. There is further differences. For the savings means interest. For the basic rate taxpayer, people up to 37,000 income, the first 1,000 is free. The first 1,000 interest is tax-free for those who are basic rate taxpayer, earning up to 37,000 plus the personal allowances, of course. And for the higher rate taxpayer, only 500. And for the dividends, it's the first 500, which is tax exempt for everybody. This used to be 1,000 last year, year before 2,000, now coming down to 500. This is one difference students will note if they are preparing for the March exam. By the way, if you are preparing for the March exam, please note the tax rate you are going to be using is for 23-24, not the 24-25. Therefore, this tax rate 24-25 is for June exam and the future exams. But the others are not of much different. Only these couple of figures are different. This is the national insurance rate. I'm sorry, there's a big numbers, so I'm very going quickly be running these numbers. Class 1 employee means in the UK, it is something unique that if you are an employee, you are paying the income tax rate at 20, 40, and 45%, depending on the level of your income, plus you are also liable to pay something called national insurance contribution. And don't worry, the word national and the word insurance has nothing to do with the national and insurance. It's just a name. It's just a different way of collecting tax, basically. And as an employee, you will be paying 8% national insurance on that 37,000, the basic rate amount. 8%. But one thing interesting, for the first time after many years, ladies and gentlemen, this 8% reduced, which was 12%. So for the first time, the national insurance rate has been reduced by a very big mark, very big percentage of 4%, from 12 to 8%. It was 12% last year and 12% for the past many, many years. So this is a year, it's a big change for employees. And for anyone earning above the basic rate band, which is 12 plus 37 is about 50,000, they are paying 2% NIC. So now, look at here. If you are earning, for example, more than £125,000, as an employee, you are paying 45% tax plus the 2% NI. So in total, 47% tax and NI on the income above 125,000 if you are an employee. Quite a bit tax, expensive, one of the expensive tax rate. I know there are countries more than even 50% tax rate, but the 47% is not too low. One more thing, in the UK, when an employer, when a company, when a business employed employees, not only the employee is paying the tax and NI, even the employer is required to pay something called Class 1 employer. That is what we call is secondary national insurance, and that's pretty high, which is 13.8%. Therefore, if a company is paying, for example, 100 to employee, the cost to the employer is not just 100 plus another 13.8 pounds, which is quite expensive, But for the first time after many years, at least for employees, they reduced it from 12 to 8%. Quite a big change. Coming further, Class 2 and Class 4 means it's just a different name for the national insurance. Anybody who is not employed but self-employed, for example, freelancer, sole proprietor, or a partner of a partnership, then they need to pay Class 2 plus Class 4 national insurance. Class 2 is flat, £3.45 per week. That's the flat. Class 4 is based on the profit, and it is 6% up to 37,000, and after that it is 2%. Again, it's a big change. For the first time after many years, it was 9% up to last year, reduced to 6%. Therefore, in the UK, especially as part of the national insurance, there is a big difference for you being employed and self-employed. The net difference straight is 2%, 8% for the employee, 6% for the self-employed. So there's a 2% NIC difference straight away for you being employed or self-employed. There are other differences as well in terms of the expenses deduction, but that's not the part of the discussion today. Right, let's carry on. So the capital gains tax. Again, I'm dealing with capital gains tax for the purpose of individual here. Individual, not for the company. In the UK, for the individual, capital gains tax rate is different compared to the income tax rate that we looked at earlier. First thing, the capital gain is not subject to national insurance and not subject to income tax rate as well. Individual has different capital gains tax rate. Again, I said earlier, it started back in 1965, quite a while back. So the 1965 means it's like more than 60 years. This tax is around there in the UK. And for the individual, the capital gains tax rate is different for the UK residential property, remember, and the other property. Other property means non-residential property, shares, and any other property come under other assets. The reason I distinguish one against the other is because if you are selling the residential property and if you are liable to capital gains tax, then the rate is higher. If you are earning up to 50,000 income, we looked at earlier the basic rate, personal allowances of 12,000 plus the basic rate income of 37,000, you fall within the basic rate. So if you have the remaining basic rate limit there, then your gain is liable to 18% up to that limit. And after that is the higher rate. For example, you have already got income of 50,000 or more, then you don't get this basic rate. You get straight into higher rate, which is the 28%. This is actually coming to 24%, which is a big change as well. And go to the other assets. Apart from the residential property, all other assets are subject to, if basic rate 10%, otherwise 20%. Otherwise 20%. Give me a sec. I'm just going to quickly check this rate once again. Actually, this 28% has already been reduced to 20. 4% from this year. Just a quickie correction here. This 28% has been reduced to 24% from this year, 24-25. It was 28% last year. Just a quickie correction. Let's carry on. So for the individual, I'm coming to inheritance tax. This is a unique tax in the UK. Not very many countries around the world, they have this inheritance tax. The first thing, it is not income tax. It is not gains tax. It is a tax on the value of the assets, unfortunately. Inheritance tax means when the assets passes through the generation on one's death, there will be tax on the remaining assets within the estate of the person who died. That's one. Two, there are some other variations as well, which you'll see here. So this goes back 1974. It used to be called capital transfer tax, and it is reintroduced as inheritance tax from 1986. There are different inheritance tax rates. One is called death rate, 40%. And the reduced death rate is 36%. Lifetime rate is called 20%. And the nil rate band is 325,000. I'll tell you what that means. What this means is if somebody dropped dead today, for example, leaving 2 million assets behind, then out of that 2 million assets, 325,000 doesn't have any tax, wouldn't have any tax, exempt. And anything above that, it would be liable to inheritance tax as high as 40% on the value, on the market value of the assets on the date of death. Sometimes it feels unfair, right? Someone dropped dead, leaving the assets behind. Now that assets can be reduced by 40% up to because of the tax. And this tax would normally be payable by the representative of the deceased person, what we call is PR, or the executors of the estate. What is the lifetime rate? In the UK, during your lifetime, if you transfer your assets to either some sort of trust or some individuals, then there may be inheritance tax on that transfer on the market value at the date of the transfer. There may be. You'll see in a minute. And if there is, it will be 20%. Let's look at it further. Chargeable lifetime transfer. This means, as I just touched earlier, if in your lifetime you are giving, you are donating, you are transferring your assets to, for example, a trust, say a discretionary trust, then it will be called CLT, chargeable lifetime transfer. And on that chargeable lifetime transfer, anything above 325,000, you need to be paying the transferor generally, you need to be paying 20% lifetime rate on the value of the assets that you transfer, generally. The donor, in some cases, donee may also pay, but generally donor. Yeah, and that's called CLT, chargeable lifetime transfer. Something called PET. PET means potentially exempt transfer. What this means is if an individual gift transfer his or her assets to another individual or another set of individual, either within the family or outside, then that may be exempt, that may be taxable. And that's why it's called potentially exempt. In what condition it will be exempt altogether? If the person who transferred, who gifted the assets to another individual, then if the transferor survives the next 7 years, then this transfer will be exempt. So the potentially exempt means if the transferor, if the donor who gifted the assets to another individual survives the next 7 years after making this transfer, this gift, then those transfer, those gifts would be completely exempt at that point in time, after 7 years. But if, as it happens, and the donor died before the 7 years, then this potentially exempt transfer now comes to charge and become chargeable. Understood? Slightly complex concept. And this chapter, the inheritance tax, wasn't there within the TX syllabus in the past. This was introduced lately. This was only part of the advanced tax syllabus in the past, but it's been few years introduced in TX as well, the taxation syllabus as well. And estate on death. This means someone who dropped dead, leaving a lot of assets behind, then those assets would go into something called estate. So all the assets the person, the individual has on his death will actually be put together and valued at the date of death. And whatever comes up minus 325,000, and if there is any other exempt assets to be removed, the rest will be liable to up to 40% of the value, which is quite a bit. And within the assets, there may be different type of assets. Sorry, within the state, when someone died, there may be different type of assets. For example, there may be cash, there may be shares, there may be land and building, there may be some other things as well. And depending on the type of assets, there may be some exempt item. Therefore, around the IST, there are quite a lot of planning opportunities, tax planning opportunities that we do for our client, especially the rich client. Give me a few minutes. For example, if somebody who is very young enough, so he wasn't doing any inheritance tax planning, very rich, dropped dead by accident, then unfortunately, there would be the grievance of the person being passed away, as well as the huge grievance of the potential inheritance tax as well, up to as high as 40%. And I know I have dealt with a number of cases around where they didn't have anything or didn't have cash to pay this 40% tax, of course, because they need cash to pay the revenue. Therefore, they had to sell the assets within the state in order to generate the cash and to pay the revenue for the inheritance tax. So quite painful. Let's carry on further. Now, let's look into the company. We looked at individual briefly, income tax, national insurance tax. All these 4 items are relating to individual. Kishore, we'll come back and talk about your queries in future. Please allow me. I will note your point. Is that okay, Kishore? Thank you. Right, coming on to company now. Company means non-natural person, another type of entity. In the UK, in order to govern the corporation tax, they have 2 acts. Corporation Tax Act 2009 and 10. 2 volumes. Now you can imagine how big the Corporation Tax Act would be. It didn't fit into one, therefore it's 2 acts. And they're quite a big, ladies and gentlemen, quite a big. And this deals with most of the corporation tax matters in the UK. And for the company, we have a concept of accounting period. Generally, the accounting period would be 12 months. We know that. But in the UK, it can be longer. It can be shorter as well. Unlike Nepal and maybe many other countries, the accounting period can be any time. It doesn't have to be like Asar Masanta in Nepal or March in any other country. Anytime, whenever a company was set up, 12 months from that point in time can be the accounting period. For example, if a company started in July, then the next June or the next July generally would be the 12 months plus few days, and that's the accounting period. So it doesn't have to be aligning with the tax year. Understood? So that's called accounting period. Generally, accounting period is a period of account of 12 months for which a set of account is prepared for the company. That's the common practice. But as I said, in the UK, this accounting period can be shorter, can be longer, but cannot be longer than 18 months. And if it is 18 months long, then when you are preparing the corporation tax return, the corporation tax would be two set. The first set of corporation tax would be 18 months, and the second set of corporation tax would be 6 months, 12 plus 18, but you submit both together. So you can prepare the set of accounts up to 18 months, do the tax calculation for 18 months, and submit the return, two sets of return for the whole 18 months period at one go. And it can be shorter than 12 months as well, in which case you prepare one set of accounts for that period and one set of tax return for that period and submit it. So it doesn't have to be 12 months always. Slightly different. And accounting period can be changed as well, making it longer or making it shorter. Making it shorter, you can technically change the accounting period as many times as you like, technically, making it shorter. Making it longer, for the first 5 years, you can do. After 5 years, you need to have a genuine reason, some sort of a commercial reason as to why you are extending more than 12 months. But if you're extending the accounting period for more than 12 months, the maximum you can make it to is 18 months, if needed. But after the first 5 years, if you're extending more than 12 months, generally you need to have some good reason as to why you are doing that. And there may be perfectly possible reason. For example, you want to align with the other group of companies and so on. So there may be perfectly valid reason to extend the accounting period. So here we call that as a financial year 2024. Earlier we said tax year. Here we call it financial year, FY 2024. But this again is slightly different by that 5 days. Here, financial year 2024 means 1 April 2024 to 31 March 2025. It's just that 5 days different compared to individual. Yeah. And this is, of course, Finance Act 2024, same as for individual. But the difference is that 5 days. But please note, this will have difference in real work, real advice, as well as your exam. Both the TX and ATX. This will have implications. So please note the difference of financial year and the tax year, but the individual and company. Corporation tax rate. First thing, there is no tax-free limit. Even if a company is making £1, is liable to pay corporation tax. So the small profit rate is 19% up to the profit of 50,000. This may to come down to 17%, but because of the COVID and the government injected a lot of funds to the businesses, government actually reverse around and increase this to 25%. It's called main rate. So the company with profit of 250,000 or more is liable to the tax rate of 25% of the company. And if there is any, for example, the profit between 50 and 250,000, say a company with 200,000 profit, then for the first 50% is liable to 19%, and the rest is liable to something called marginal rate up to 26.5%. And there is some sort of a standard calculation fraction, which obviously we're not looking into it, but it is a formulatory calculation we have. And that's provided in the law. So that's called a standard marginal relief fraction. So here is another slight difference. For individual, we looked at non-saving income, for example, the self-employment income, freelancer income, sole proprietor income, or the employment income, or the partnership income, or the rental income. They're all liable to tax under non-saving, which is 20, 40, and 45%. Interest income, after certain limit, again liable to 20, 40, and 45%. Dividend, different rate. But here, and the capital gains tax rate is different, 18, 24, and 10, and 20%. But here for the company, whether it is profit or capital gain or other taxable income, for example, interest, rental, etc., they are all liable to one rate, either 19% or 25% or the 26.5%. So they will all be put into one pot, and whatever comes up is liable to tax as one figure. And you'll be doing one calculation in terms of tax. So first, you calculate the business profit, maybe the capital gains, maybe other taxable income, put together into one column, add them up, and whatever comes up would be liable to tax at one rate, not the different rate. But usually in the UK, if one company receives dividend from another company, whether UK or the foreign companies, that dividend is not liable to tax in the hands of the recipient company. For individual, they do. You saw it earlier. But for the company, dividend is not liable to tax on the hands of recipient company from the other company. Right. Chargeable gains, capital gains. You calculate the gain part way through similarly as for the individual. But after a level, the calculation would also be slightly different. But when it comes to the final taxable gain, that taxable gain would go back to the total profit, as I just mentioned earlier. So the working of the calculation or the working of the capital gain would be slightly different for individual and company. And for the company, again, I want to reiterate, there is no separate capital gains tax rate. Once you calculate the chargeable gain, you bring it back to the main pot and total them up and pay the tax either at 19% or 25% or whatever applicable. If there are owner-managed companies or the small, medium companies, we call it, there are number of profit extraction tax planning possible. The legitimate, perfectly valid, perfectly workable tax planning is possible. This is mostly for the advanced tax students, as well as who are working or planning to work in tax advisory and planning in future. Right. Please bear with me for a few more minutes. Value-added tax, VAT. Again, this is the VAT Act 1994. Usually in the UK, businesses are required to account for the VAT. Usually quarterly, but there may be monthly as well. And of course, annually. So in the UK, generally, VAT return is done quarterly. And the quarter doesn't need to be in any particular order, doesn't need to be calendar quarter. You can choose those 3-month quarter in a way you like as a business. The business can be sole trader, the business can be partnership, and the business can be company as well. So if any business, whether sole trader or partnership or the company, if they are liable for the VAT, then they do VAT in a similar way. And the return is, as I said, quarterly, usually, but can be monthly as well as yearly. At different cases, but usually quarterly. And there is 1 month and a week. You have the time limit to submit the VAT return and to pay. Pay electronically, submit electronically. 1 month and a week available. It used to be 1 month, but 1 month and a week now, because that week is allowed for doing it online and paying it online. VAT rate, standard is 20%, one of the expensive VAT rate. Lower rate is 5%. There is something called zero rated as well, and there are quite a bit of VAT exempt, or the what we call is outside scope of VAT items. Again, we're not going through any of these in any detail at this stage, but I may do come up with an individual session on some of these topics in future. But for now, this is a general overview. And in the UK, VAT registration threshold is relatively lower. If I compare this to Singapore, this is very low, 90,000. What this means is if any business, whether sole trader, partnership, or limited company, has the turnover of 90,000 or above in a 12-month period, then that business is mandatorily liable to register for VAT. And if it is below 85,000 in future, then you can ask revenue for deregistration as well. In the UK, you can do voluntary registration as well, even if you do not have 90,000 turnover in 12 months' time. So you can ask revenue for the voluntary registration as well. But when you are doing the voluntary registration, you actually need to give the reason as to why you want to register for the VAT. And the UK has a number of different schemes for VAT. Something called cash accounting, something called annual accounting, and there are a number of retail schemes as well for VAT. This particular scheme around is not the part of the taxation syllabus, but for the purpose of general discussion here. And within the retail scheme, there is something called POS, point of sale, apportionment method, direct calculation scheme, etc. And there is one more specific scheme that I want to touch base is something called VAT gross margin scheme. For example, sale of second-hand goods. In this one, especially when you are buying, say, a second-hand car and then selling to someone else, then you are paying VAT only on the difference, only on the gross margin. So you are not claiming the input VAT, but when you are selling it, you are only paying the VAT on that gross margin. That's called gross margin scheme. And this is very popular in the UK for second-hand, for example, vehicle businesses. Actually, I dealt with quite a few around this in the past. There's one thing I want to touch base is that in the UK, VAT on land and building is there, but it is one of the very complex area. One of the very complex area. VAT on land and building. Because it involves big sum as well as the VAT Act has a very complex set of rules around land and building, whether the old building, new building, commercial building, residential building, conversion, etc. Right. Finally, I'm going to very quickly run through on this called stamp taxes. Stamp tax means property transfer tax in simple terms. In Nepal, there's something called Malpot or Malpot tax, Malpot Kar, Sampati Kar is around the stamp taxes. Very quickly, it's on a property transfer. That could be shares and security and land and building. And this is liable on the sale price, on the transfer price, on the what we call is consideration, but the full price. I know in Nepal, when you are buying a land, for example, whatever market price you are paying may be different, and whatever you are going to be reporting in Malpot office is different. That's called Thaili amount. And Thaili amount can be and usually be lower than the actual market price that you pay for the land, for the property. But in UK, it won't work that way. It is the market price that you paid, you put on the transfer document, and that's called consideration. And the stamp duty is liable on that full market price that is paid or payable. But if it is transferred for free, for example, gift within the family, then SDLT won't be liable. There are three different terminology that I want to touch base: stamp duty reserve tax, stamp duty land tax. A stamp duty simply means when you are transferring the shares on a physical transfer form, then you pay something called stamp duty, which is 0.5% on the value. And if you agreed to transfer, not the actual physical transfer form, but you agreed to transfer the shares, then it's something called stamp duty reserve tax. Technically, they are the same thing, both 0.5%. But the stamp duty land tax is completely different. So the rate is this: stamp duty or stamp duty reserve tax, both 0.5% on the shares, securities, and the stamp duty land tax rates are various and complex. And generally, of course, these stamp taxes are payable by the purchaser of the assets. And the stamp duty land tax rates are different and complex. For the residential property, up to 250,000 is nil. Anything above 250 up to 950 is 5%. And again, anything between 950 and 1.5 million, 10%, and anything above 1.5 million is 12%. Quite a bit. And for the non-residential, it is cheaper, as you can see. So for the residential property, the stamp duty land tax is pretty expensive. You can see if you're buying a property above 1.5 million, it's a straight 12%, which is quite a bit. Plus, if a company is buying a residential property, there is extra 3% charge in addition to that. That means if a company is buying, the rate could be as high as 15%. And not just this, there are various other rates and the cases around the SDLT rate and the rules, which are pretty complex, which is obviously part of our discussion today, but pretty complex areas. Again, stamp duty is something more part of the advanced tax syllabus than the tax. Ladies and gentlemen, I welcome any feedback you may have. Please either email me or WhatsApp, or please put some messages for me in the LinkedIn. I would welcome your feedback, good or bad, like or dislike, I would welcome. Thank you very much for the anticipated feedback. And if you have any question, I'll be here around 5-10 more minutes. Please feel free. Please unmute yourself, switch on your video as well, and ask me. I'm very happy to reply for the next 5-10 minutes. Thank you.